Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'm Mike Togley, the publisher of ABL Advisor, and today my guest is Joe Lane, the vice chairman at Napier Park Global Capital, and Joe also serves on the firm's management committee. Joe is a global leader within the commercial finance sector. His experience includes president and CEO of GATX Capital, CEO of GE Technology Finance, president of IBM Credit Corporation, Group Executive of IBM Global Financing, and Senior Vice President of IBM Corporation. Joe has also served on several corporate and philanthropic boards across North America, Europe, and Asia, and he is also an active participant across industry forums, having served as Director, Vice Chairman, and Chairman of the Equipment Leasing and Finance Association, and a Trustee and Chairman of the Equipment Leasing Finance Foundation. In 2015, Joe was elected by the ELFA to the Equipment Finance Hall of Fame. Thanks very much for being here today with us, Joe.
Thanks, Mike. Great to see you as well.
Well, what I'm going to do is start right in with you, if I can, today. And that's really, I guess what I'd like to start with you is a little background about Napier Park's real asset group, and more specifically, the types of investments that you're seeking in the transportation and industrial sectors. So can you give us a little background, Joe?
Sure. Our real asset strategy focuses on typically long-lived critical use equipment that can be depreciated more rapidly than the diminution in economic value, and that typically generate visible cash flows through contractual rents, meaning that they're leased into the marketplace. We match these assets with our investors. Our investors are of a wide variety, but heavily dominated by insurance companies, pension funds, investors with long dated liabilities. So they're looking for both total return as well as current yield. And so we build portfolios within the asset classes that we focus on that provide both of those features. When we approach the real assets opportunities and the asset types that we have focused on include commercial aircraft, North American rail cars. We have a joint venture in which we pursue general production, primarily pharmaceutical equipment and its disposition. And we continue to look at other sectors where the asset classes fit the general profile. So we've considered things like inland waterway, barges and tugs. We've looked at containers and chassis. We've looked, and especially recently, at renewable energy sources, solar power, and other asset classes that fit the general description that I provided earlier. When we look at the assets, we try to build portfolios that mitigate risk by including diversity in the composition. So for example, in an aircraft fleet, diversity and a mix between narrow body and wide body in different geographic locations. The counterparties, some will be better credit, some may be less credit worthy, but offer perhaps higher return. The balance is very important, including the tenor of the underlying leases. We try not to have too much of our portfolio coming off in any one year. And so the spreading of the risk is very important. The second major plank next to the assets is our operating partner. We have made the strategic decision not to build our own operating platform. We have a very small number of people within Napier Park dedicated and committed to the real assets strategies, but we work with best-in-class operating partners in the marketplace so that we can put together compatible, complementary relationships where our capacity allows them to do more of what they do well. It allows them to spread some concentration risk by sharing some of that with us, and generally allows us access to transactions and deal opportunities that a pure financial player would not otherwise have. So the operating partner is crucial. And we work with Air Lease Corporation on commercial aircraft. We work with Trinity Industries on rail cars. We have a joint venture with AAR Corporation on end-of-life commercial aircraft. and with Heritage Global on industrial equipment and primarily the pharmaceutical equipment repositioning, remarketing. The third plank of our platform is the structure of the deals. So when we put together our arrangements with our operating partners, finding alignment of interest is crucial, so that we don't want to be either a favorite buyer or a buyer of last resort. Instead, we want to be strategically woven together so that we're working in ways that are both complementary to each other, but that we're benefiting from each other's strengths. And so the structure of the transactions and the structure of the partnerships is crucial.
Well, that's a very comprehensive background. So I'm curious, one thing is, are you doing transactions and conducting business globally, or is it primarily domestic in the United States or maybe North America?
It depends on the asset types. Our rail fleet is primarily North America. And of course, the rail fleet in North America is deployed Canada, US, and Mexico. So it's free running. Our commercial aircraft fleets are global. In fact, for quite a while, until earlier this year, we didn't have a single North American lessee. Well, we had one. We did have an aircraft at Air Canada, but we didn't have a US lessee until earlier this year. We have now, and we have a couple of aircraft at Delta. But most of our lessees are international on our aviation fleet.
Okay, and I'm just curious as well. Any corporate air here, or just when we talk about just airline side, the air sector?
We have not participated in corporate aircraft. Instead, it's the larger commercial aircraft. With only one exception, all of our aircraft are Boeing and Airbus.
Okay, great. So I'll jump into the second question here, and this has to do with what's been in the news a lot, and I'm curious how it might be impacting some of the industries from your perspective. You know, several sectors have been impacted by the global supply chain issues, as we all know. What are you seeing today in the sectors that Napier Park is targeting for investment? And what's your outlook related to the supply chain issues in those sectors?
Well, one feature of the types of assets that we look for, as I described before, the typically long-lived critical use equipment, with the useful lives of rail cars, for example, being 40 plus years, 40 or 50 years. The intrinsic value of that asset is intended to ride through short-term cycles. And so supply chain issues will come and go. Market peaks and valleys will come and go. The idea lying behind our real asset strategy is to select portfolios of assets and to build portfolios of assets that can ride through the short-term cycles. So as we see the supply chain challenges, longer-term leases on our existing aircraft and rail cars primarily will help us ride through that. However, we are seeing the impact of the supply chain crunch in all the assets that we work with. So, supply chain has been an issue with the aircraft manufacturers, as everyone knows. That has led to some delays in delivery of new aircraft. On rail cars, most of the supply chain that people read about in the newspapers has to do with the import of goods and products primarily into the West Coast. Those goods and products come onto well cars or stack cars, containers on stack cars. We don't have many of those in our fleet. And so the primarily consumer-driven supply chain issues haven't been as much a direct effect on our rail car fleet. There are some downstream effects and ripple effects, though. So, for example, the supply chain shortage in computer chips, which is affecting the auto manufacturers. If auto manufacturers can't build cars, they don't ship them in auto racks, and auto racks we do own. And so we're feeling the indirect ripple effect. Natural gas prices being as high as they are, have a ripple effect on the fertilizer industry. And so our bulk carriers that carry fertilizer in our rail cars are feeling some of that effect. But again, it comes back to the longer leases that we have with high quality lessees, and that helps us ride through these short-term effects. On asset acquisition, the the inability to acquire new or replacement equipment necessarily adds some value to existing equipment. And so as we already own fleets, we are enjoying and hope to enjoy more some of the shortage that comes from the inability to build new as quickly as you might without the supply chain interruptions.
So at the end of the day, when I think it's, as you mentioned it, the long-term leases, the effect of the long-term leases in some way, maybe it's not the right word, provides somewhat of a hedge in the risk that you're underwriting. Is that correct?
That is correct. More than a hedge, obviously it's a structural feature. We like to have long-term leases, although, as I indicated, some mix of tenor of the underlying leases is an important risk mitigant in building a portfolio. So we like long-term leases with good credits. We look for opportunities to deploy equipment and to adjust the length of term of the leases according to current conditions in the market. As you might appreciate, especially in railcar financing, when the prevailing rates payable to lessors might be lower, a lessor's natural inclination is to keep the term shorter. If rates are high, lessors want the terms to be longer. And of course, the counterparties have the opposite side of that trade in mind. And so how to find that balance is an interesting cyclical component within the overall useful life of the asset.
So the blend of the useful life of the asset being somewhere, let's just say 7 years plus on the useful life of the asset, is that typically what you're looking at here? I would think that it's not below 5 years. Is that correct?
That's correct. Shorter term assets in a portion of my previous deployment in the industry, working on technology assets that have a much shorter life cycle. The life cycle of the assets that we're focused on would be much longer. So the life cycle of rail cars, railroad freight cars, in the 40 to 50 year range. The life cycle of commercial aircraft being 20 years plus, 2025. Other assets, as I indicated, we've considered, whether that's inland barges or others, would be typically very long lived to ride through the cycles.
Okay, thank you, Joe. Thanks for the explanation there. So I'm going to switch a little bit here again and talk about another thing that's been going on, and that is inflation. Inflation is in the headlines. It's taken its grip on the U.S. economy to some degree, and also globally. Are you seeing the impact of, we talked about supply chain. Are you seeing the impact of the inflationary pressures in the industries in which you're focusing on as well?
We are, and in some ways, the return of inflation, I'll call it that, having been through several inflationary cycles in a career, is a credentialing of our overall strategy. So if you knew for a fact that we were entering an inflationary period, you'd be inclined to invest in things like real assets or real estate or things that are positively correlated to interest rates and rates of inflation. So in our fleets of real assets, we see a potential benefit of being a component of an overall investment portfolio to have some exposure to these assets that do have that positive correlation. Another feature that results from inflation is the increase in cost of replacement equipment. So as replacement equipment increases in cost, there's a natural drag on the underlying value of existing equipment. So if you have a covered hopper car that carries grain or fertilizer, the shipper doesn't really care much about how dented it is or what color it is or whose name is on the side. It's just the capacity and the availability. And that comes back to our desire to work with the best-in-class operating partners, such as Trinity Industries, where making that car available and making that capacity available is what adds value to an otherwise commodity product. And so a hopper car is a hopper car. Being able to keep it at work with a good lessee is where the magic occurs. And so that's how we pursue. And as inflation occurs, we expect to see an increase both in the rates, because in order to build new equipment, an investor would have to be satisfied they can charge an appropriate rate to get a return on that invested capital. If we're already invested at a level that has been already depreciating from our cost of entry, we should be advantaged as we go forward in an inflationary environment. So we see that as a positive for us.
Do you see the inflationary pressures continuing, Joe? Just, I know you're not an economist, but what's your thoughts on the inflationary environment right now and its longevity?
It's extremely difficult to tell. Anything that I answer would be wild speculation, but not being an economist has never kept me from speculating. Not being a lawyer has never kept me from the unlicensed practice of law. So I will say that the underlying pressures right now appear to be such that this is the terminology of whether it's transitory. It's been fascinating to me to read the experts in saying it's probably still transitory. It's just transitory over a longer period of time. And so whether that feels more permanent, whether that feels more structural, my personal belief is that some degree of greater inflation, which is why I referred to it as return up to inflation before, I think we're into this for a little while.
Yeah, fair enough, Joe. I appreciate that you gave us your insights, despite the fact that you said that you're not an economist and such. I do appreciate that.
Right.
You know, deal activity. Let's talk a little bit about deal activity for a moment. How would you describe the deal activity over the past 18 plus months? I mean, we've gone through COVID. I don't really want to focus on COVID too much, but how would you describe that deal activity? And did any unforeseen opportunities? I'm curious about that. Were there any unforeseen opportunities that you saw at Napier Park as a result of what was been going on since the pandemic?
There were, and we have been able to exploit some of those opportunities. Thinking about our aviation strategies, this is just as an example. Through the period late 2018, 2019, the commercial aviation markets were basically a seller's market. I mean, you know, there was a lot of capital chasing every opportunity, every transaction. For us and our investors, the available returns or risk-adjusted returns were far less attractive. And so we were patient, and we tried to be patient capital. What that did for us, and I'd love to be able to claim foresight, but it just happened. We came into 2020 with a meaningful amount of dry powder. And what that meant is that as the effects of COVID pounded the aviation market, the capital sources that had been there came under some stress. The need by airlines and others for continuing access to capital didn't slow down. They still needed it. So we found ourselves in the middle of 2020 facing some opportunities that hadn't existed for the preceding 24 months. So I would put that in the category, Mike, of what you're asking about, the opportunistic. From the period August of 2020 through first quarter of this year, 2021, we found opportunity to deploy over $700 million of capital in the aviation industry. And this wasn't really, it wasn't buying $100 airplanes for $60. You know, that just didn't happen. What did happen was there was a rebalancing of the overall risk-adjusted return. And so credits that prior to that time had been able to find and source capital in the market at rates that we didn't find attractive enough to generate a return, were suddenly willing to discuss rates that provided the kind of returns that we could enjoy. Longer terms on, you know, so the opportunity to work with better credits on high quality equipment, because most of this involves new acquisitions of new generation, you know, best technology equipment, and for longer terms, you know, better terms in the leases. those all presented themselves, and we actually built a highly attractive additional aviation portfolio, and it was credentialed when we went to take out our warehouse financing, under which we were assembling the fleet into the ABS market, and we were able to place the longer term financing at what turned out to be the second lowest coupon rate that had been done in aviation. And so, yes, we found opportunity and we jumped on it.
Well, it's like anything else. When sometimes it takes an unusual circumstance to create these type of opportunities. Hopefully, some of them will continue for you without too much angst in the marketplace. Do you foresee some continuing opportunities? You're always looking for opportunities. Are there any other sectors, I'm curious, besides aircraft, do you say there might be some opportunities coming up?
There might be. We actually are quite close to signing a new agreement with another operating partner, and this would be particularly exciting because it's in renewable power generation. This will involve primarily solar power generation, but the underlying factors are all very similar. Trying to find a way to migrate to an improvement overall. All of our customers are being driven by their owners, by their other constituents to meet ESG objectives. ESG is everywhere. It's omnipresent. Everybody has those goals. It's challenging when you're dealing with equipment like commercial aircraft that are fundamentally fossil fuel burners. It's hard to get a meaningful ESG statement there. Our strategy in aviation focuses on the bookends, meaning that we work with Air Lease Corporation on the early life equipment, new build and early life. We work with AAR Corporation on the end of life, meaning when aircraft are typically on their last lease, and we view those opportunities, those investments, as acquiring equipment that may stay on lease for another short stub period, but then we're going to break it down into parts. And those parts will find their way back into the overall food chain in supporting the existing equipment. One of our colleagues actually referred to it as, oh, well, that's very ESG friendly because it's recycling. When, we hadn't really thought of that phraseology before, but in a way, one could think of it that way. So we haven't really focused at all on the middle section or the midlife aircraft for two reasons. One is there's no barriers to entry. It takes a checkbook to play in the midlife aircraft sector, and cost of funds is what drives. We like the differentiated requirements that apply to the new early life equipment, where having an order book and talking with airlines about their fleet planning longer term, as opposed to an individual one-off sale leaseback or financial driven transaction. Operators like Air Lease are having conversations with lessees about their long-term plan. How are we going to refleet with the newest technology, with the aircraft that meet the most stringent ESG standards that we can meet? Those are important to us, and that's why we want to work with them. At the other end, working with AAR, as more and more equipment is being taken out of the marketplace, to harvest and recover parts and components that can be efficient, so that the reuse of existing equipment, as opposed to having to manufacture new equipment to go into the service and maintenance cycle of aircraft, that is efficient. There are efficiencies around that. In our rail fleet, we were very fortunate to issue the first 2 green bonds in our ABS on rail fleets. And we were able to do that because we structured the composition of the portfolio so that the underlying assets were ESG friendly. We kept the more offending equipment out of that issuance, and we own that outright. But we were able to structure within the fleet an attractive offering for the ABS marketplace, and we actually got 2 certified green bonds that were part of our financing there. And so we're looking at all of the opportunities in all the sectors. And as I indicated, the renewable energy, we continue to explore. We are members of the Aviation Working Group, which takes the long view over the horizon on things like sustainable airline fuel, on regulatory environment when it comes to documentation and requirements and maintenance objectives. Those are all things that we think are very important to be involved with, not just on a financial transaction basis, but on bringing capital into the industry that doesn't otherwise have a good route or a good access. So through us and our operating partners, our investors have access to what they otherwise wouldn't have. And that's what we see to be our raison d'etre.
Okay, Joe, that's a lot there. And I'm glad to see that these opportunities have presented themselves. And obviously, as you said, the ESG initiatives are everywhere and people continue to strive to meet them somehow, but you're providing another avenue to meet those goals in some unique ways. And that's very interesting, actually. You know, we're now in December of 2021. We're about to be in 2022. And I'm curious, is there anything that you're most concerned about as we move into the new year? Is anything top of mind for you?
Mike, the two things that that make me wake up at night are uncertainty overall and inconsistent regulatory environments. We see that at play, again, coming back to the aviation field. You know, 3 weeks ago, the aviation industry was looking pretty optimistic. You know, both Boeing and Airbus were able to announce big new orders. Traffic was increasing. People were getting back into a travel mode. And then Omicron hits and we've got a different environment. It's that uncertainty and the almost recoil reaction, because a lot of the shutdown that occurred immediately was done before there was a thorough, widely accepted understanding of what the real impact was going to be. I have a little anecdote about the reason that the shutdown wasn't as harmful or wasn't as hurtful as it might otherwise have been. I was out of the country last week, and in coming back in this past weekend and talking to the pilot, I happened to be in Israel, and when Israel closed the border, it meant that aircraft coming in to fly people out were coming in empty. So they were essentially deadheading into the country in order to keep their schedules to fly passengers out. And when I spoke with the captain, he said that part of the reason they were able to do that was that the shutdown was stated to be a 2-week shutdown. Had it been indefinite or never ending, they might have had to arrive at a different conclusion. But because it was for a finite period, they could keep the cycling of the aircraft. They could keep the fuel movements that they needed to do for the aircraft. They were able to manage that because it was just a little more clear about the time frame as opposed to the open-ended uncertainty. As we look at international travel, especially, differing regulations, differing requirements in differing jurisdictions, it's particularly challenging, say in the European environment where there are so many different authorities. Asia is very challenged as well. In the markets where there is either a large domestic or a controlled regional marketplace, those are opening back up. A lot of the traffic in those controlled environments is back to 80% plus of what it was 2019. It's the long haul international markets that may be a little more challenged in coming back. And it's the uncertainty that that creates that, and the different regulations that get imposed. The newest regulation on having to get a COVID test to come back into the United States within 24 hours of your flight. The sheer logistical challenge of that means that people will choose probably not to fly. Whereas last week, when it was 72 hours and you could physically handle that, it was a little easier. So we're going to see these ups and downs and ups and downs. And as I look into 2022, in answer to your question, it's the it's the uncertainty and the inconsistency that I see as most challenging.
Yes, it's very interesting. The newest challenge that comes across, and we all wait to see if there's going to be another one, but hopefully not. But and everyone reacts to it differently.
Yes. Yeah.
All right, Joe. Well, I'm going to wrap this up with just allowing you to give us any parting thoughts you have. We've talked about quite a few things here. Is there anything you want to wrap this up with? Maybe I didn't ask, or anything else you want to just talk about a little bit today?
Nothing else. You've asked some very good questions. I appreciate that. The one thing that I remain optimistic about, and counter to what concerns me about 2022, is I think about the fact that several years ago, someone asked me, what is it about the equipment leasing and financing business that attracts you so much? And I described it then as I see it now. It is the perfect intersection of financial structuring, credit underwriting, tax structuring, capital markets, and all of that plays out where it meets something tangible. It meets an asset that you can actually go and touch or sit in or drive or move earth with. And to me, that's very, very exciting. And the opportunity to be involved with Napier Park now in a way where we're introducing our investors, and hopefully an expanding sphere of those investors, to these opportunities remains very exciting, and I'm filled with optimism about the chances going forward. So.
It's exciting. It's nice to hear all the good things that we always knew about the industry and how you can take it to the next level from your perspective. So, Joe, that wraps it up for me today. I just wanted to say thanks again. It's been a long time since we've seen each other, but I do appreciate your time today. I know you're very busy, and I do hope that you have a wrap up the year very strong. I know that you will, and I hope that 2022 presents many new opportunities for you as well. And thanks for being here.
Thank you, Mike. It's great to see you again as well. And I appreciate the good wishes. Thanks for this opportunity.